Goldman Sachs just released their biggest outlook report ever. Over 100 pages of analysis, charts, and predictions for 2026 and beyond. Within hours, headlines started appearing everywhere claiming Goldman was predicting a market crash. Financial influencers began posting videos with alarming thumbnails. Panic started spreading through comment sections. There's just one problem. That's not what the report actually says. I spent the past week going through every page of this report, cross-referencing their data, and separating what Goldman actually predicts from what clickbait creators want you to believe they predict. What I found is far more nuanced and far more useful than either the doom and gloom crowd or the permabulls want to admit. The truth is, Goldman Sachs is not predicting a 2026 crash. They're predicting something that might actually be harder for most investors to handle, something that requires a completely different playbook than what's worked for the past 15 years. Today, I'm going to walk you through exactly what Goldman's report reveals, the specific risks they've identified that most coverage ignores, and most importantly, what this means for your money in 2026 and the decade ahead. Let me start with what the report actually says about 2026. Goldman Sachs titled their report, U.S. Resilience Resilient. That title alone should tell you something. This isn't a doom report. It's a report arguing that despite significant risks, the American economy and stock market have proven remarkably durable and will likely continue to be. Their headline prediction for the S&P 500 in 2026 is a 7% return. Not a crash, not stagnation, a solid 7% gain. Let me break down how they arrive at that number, because the components matter. Goldman expects 11% growth from corporate earnings, plus dividend yields. American companies continue to generate strong profits. The artificial intelligence infrastructure build-out continues driving spending. Consumer spending remains healthy. Those fundamental drivers produce solid growth in the underlying value of American businesses. But then, Goldman subtracts 4 percentage points from that 11%. Why? Because they expect price-to-earnings ratios to compress. Stocks are expensive right now. Goldman believes some of that premium will erode over 2026 as valuations gradually normalize. 11% fundamental growth minus 4% valuation compression equals 7% expected return. That's their base case for 2026. A 7% return would be below the historical average, but still solidly positive. It's not the explosive gains of 2023 and 2024, but it's far from the crash that headlines would have you believe. Goldman also quantifies recession risk at approximately 25%. That means they see a 75% probability of continued economic expansion. Not insignificant risk, but not a coin toss either. Not a prediction of imminent collapse. So why are so many people claiming Goldman is predicting disaster? The answer lies in a different Goldman report that came out several months earlier. In October 2024, Goldman released a long-term forecast predicting the S&P 500 would return only 3% annually over the next decade. That number generated massive headlines and continues to fuel crash narratives. Here's what most coverage misses. The 3% figure was for the S&P 500 specifically, driven by concerns about market concentration and high valuations. Goldman's global equity forecast was higher at 7.7% annually, and even their pessimistic U.S. forecast represents below-average returns, not negative returns. More importantly, Goldman explicitly states that low expected returns do not mean a crash is imminent. Markets can remain expensive for years while still generating positive returns. The path from expensive to fairly valued doesn't require a crash. It can happen through years of modest gains while earnings catch up to prices. Let me show you what Goldman's own data reveals about expensive markets. The report includes a fascinating chart showing market returns from different valuation starting points. They break historical periods into deciles based on how expensive stocks were at the time. In the 1990s, the market entered the 9th decile of valuations, meaning stocks were more expensive than 90% of historical observations. What happened next? The market rose another 342% before the eventual correction. In 2015 through 2017, valuations again reached the 9th and 10th deciles. The prediction would be poor forward returns. What actually happened? A 200% gain followed. After COVID, despite being in the 9th decile of valuations, the market gained another 100%. Goldman's own data demonstrates that expensive markets can remain expensive and continue rising for extended periods. High valuations are a risk factor, not a crash trigger. The timing of any reversion to historical norms remains unknowable. This doesn't mean valuations don't matter. Over very long periods, starting valuations strongly predict returns, but the operative phrase is very long periods. Trying to time a market correction based on valuation alone has been a losing strategy for decades. Now let me address the valuation concerns that are legitimate, because they do exist. The cyclically adjusted price-to-earnings ratio, known as the CAPE or Shiller PE, currently sits around 39 to 40. To put that in context, the historical average is approximately 17. We're at more than double the long-term norm. This is only the second time in 155 years of market history that the CAPE has exceeded 40. The only other time was during the dot-com bubble of 1999 and 2000. That comparison understandably alarms people. The dot-com crash erased trillions in wealth and took 13 years to recover from peak to peak. But Goldman's analysis argues that direct comparison is misleading for several reasons. First, the composition of the index has changed dramatically. Today's largest companies are highly profitable businesses with strong balance sheets, durable competitive advantages, and substantial free cash flow generation. The dot-com leaders were often unprofitable companies valued on hope rather than fundamentals. Second, profit margins have structurally increased. American companies today generate higher margins than historical averages, partly due to the shift toward asset-light technology businesses. Higher margins can justify higher valuations. Third, interest rates matter for valuation. When bonds yield nothing, stocks deserve premium valuations because they're the only source of meaningful returns. While rates have normalized from zero, they remain below historical averages when considered alongside inflation. Goldman's position is nuanced. Valuations are a headwind for future returns, but not the dominant factor. They expect valuations to gradually compress, subtracting from returns, but not through a sudden crash. Now let me address market concentration, which Goldman identifies as a more significant concern than most investors appreciate. The top 10 stocks in the S&P 500 now represent over 40% of the entire index. This is the highest concentration level in recorded market history, exceeding even the dot-com bubble peak. Think about what that means. If you own an S&P 500 index fund, 40 cents of every dollar you've invested sits in just 10 companies. The other 490 companies share the remaining 60 cents. The Magnificent Seven, the dominant technology companies, alone account for approximately 35% of the index. NVIDIA, a single company, represents nearly 7%. Goldman's research shows that historically, high concentration levels have been reliable predictors of lower forward returns and higher volatility. When an index becomes dominated by a few names, its performance becomes dependent on those specific companies rather than the broader economy. The concern isn't that these companies are bad businesses. They're exceptional businesses. The concern is that concentration creates fragility. Any problem specific to these companies cascades through portfolios that investors believe are diversified. Consider what happens if artificial intelligence spending disappoints expectations. The hyperscalers, the companies building AI infrastructure, represent an outsized portion of the index. A shift in AI sentiment could trigger selling across the entire market, even if most companies are unaffected. Goldman notes that concentration itself doesn't cause crashes, but it amplifies whatever comes next, positive or negative. Today's market will move more violently in either direction than a more diversified market would. This is why Goldman suggests the equal weight S&P 500 may outperform the standard index over the next decade. Removing the concentration effect could produce better risk-adjusted returns even if the largest companies continue performing well. Let me walk through the other risks Goldman identifies in their report. The first major risk involves U.S. government debt. The debt-to-GDP ratio continues rising, and Goldman's projections show no reversal in sight. They outline various policy options that could address the trajectory, including tax increases, spending cuts, and entitlement reforms. But they don't predict any of these will actually happen. Rising debt creates multiple risks. Higher interest payments crowd out other government spending. Larger Treasury issuance competes with corporate borrowing. At some point, investors may demand higher yields to hold U.S. debt, raising rates across the economy. Goldman isn't predicting a debt crisis. They're identifying it as a persistent background risk that could materialize if some catalyst triggers a reassessment of U.S. creditworthiness. The second major risk involves China, and specifically supply chain dependencies. Goldman highlights that China controls nearly 70% of rare earth mining, 92% of rare earth refining, and 94% of global magnet production. These materials are essential for electronics, electric vehicles, and defense applications. Additionally, pharmaceutical supply chains remain heavily dependent on Chinese precursors. This dependency creates vulnerability that has already manifested in trade tensions and could escalate further. The third major risk involves monetary policy uncertainty. Goldman describes the environment as mixed monetary policy, with central banks around the world moving in different directions. The Federal Reserve has begun cutting rates, but the path forward remains unclear. Some Fed members expect further cuts, while others see rates holding steady. This uncertainty creates volatility risk. Markets have been trained to expect the Fed will rescue them during downturns. If inflation concerns limit the Fed's ability to cut rates during a slowdown, that assumption gets tested. The fourth major risk involves what Goldman calls localized vulnerabilities around the world. Political instability in various regions, banking stresses in specific countries, and real estate problems in certain markets could create contagion effects even if the U.S. economy remains healthy. Now let me share what I found most valuable in Goldman's report, their investment philosophy section. Goldman outlines 5 pillars for their approach: history as a useful guide, appropriate diversification, value orientation, appropriate time horizon, and consistency. These pillars rest on a foundation of proper asset allocation. What strikes me about this framework is how boring it sounds compared to the excitement of crash predictions and moonshot forecasts. Yet Goldman's research team, one of the most sophisticated in the world, builds their entire approach on these mundane principles. They include a chart showing the cost of missing the best days in the market. Since March 2009, staying fully invested produced almost 17% annual returns. Missing just the 10 best days dropped returns to 12%. Missing the 25 best days cut returns in half. The best days often occur during the most volatile periods when investors are most tempted to sell. The investor who panicked during COVID missed some of the strongest days in market history. The investor who fled during the 2022 decline missed the subsequent recovery. Goldman's implicit message is clear. Trying to time market crashes destroys more wealth than the crashes themselves. The cost of being wrong about crash timing exceeds the cost of simply staying invested through volatility. Let me synthesize what Goldman's report actually means for different types of investors. If you're a long-term investor with a 20-plus year horizon, Goldman's message is straightforward. Stay invested. Don't try to time corrections. Accept that the next decade will likely produce lower returns than the past decade, but positive returns nonetheless. Consider diversifying beyond U.S. large-cap stocks to capture potential outperformance in other areas. If you're a medium-term investor with a 7 to 15-year horizon, Goldman's warnings deserve more attention. A decade of 6 to 7% returns instead of 13% returns means your portfolio grows much more slowly than you might have planned. Run updated projections. Consider whether you need to save more, work longer, or adjust expectations. If you're approaching retirement within 5 years, the concentration risk Goldman identifies matters significantly. A portfolio heavily weighted toward the S&P 500 is actually a concentrated bet on 10 companies. Consider whether that concentration matches your risk tolerance at this life stage. If you're already retired and drawing from your portfolio, Goldman's forecast of lower but positive returns is actually relatively benign. Your sequence of returns risk, the danger of withdrawing during a downturn, remains present but Goldman isn't predicting the severe crash that would trigger that risk. Here's what I'm personally taking from Goldman's report. First, I'm not changing my long-term strategy based on valuation concerns. Goldman's own data shows that expensive markets can stay expensive for years while still producing positive returns. The opportunity cost of sitting in cash waiting for a crash has historically exceeded the cost of riding through corrections. Second, I'm paying more attention to concentration. 40% of the index in 10 stocks concerns me, not because those companies are bad, but because it creates correlated risk. I'm increasing my allocation to equal weight strategies and international markets. Third, I'm extending my time horizon mentally. If Goldman is right that the next decade produces 6 to 7% annual returns instead of 13%, I need to adjust expectations accordingly. That's still positive compounding, but at a slower pace than recent experience suggests. Fourth, I'm maintaining larger cash reserves than I would in a lower valuation environment. Not because I'm timing a crash, but because having liquidity during volatile periods allows me to rebalance opportunistically rather than being forced to sell at bad times. Fifth, I'm ignoring the crash predictions. Goldman's actual forecast is for continued growth with elevated risks. That's not the same as predicting collapse. I'm not going to make dramatic changes based on misrepresentations of what sophisticated analysts actually believe. Let me address something that underlies the entire crash prediction industry. Fear generates clicks. A headline saying, Goldman predicts 7% return, doesn't drive engagement. A headline saying, Goldman warns of crash, generates millions of views. The incentive structure of financial media pushes toward catastrophizing. This creates a persistent gap between what analysts actually say and what headlines claim they say. Goldman's report is cautiously optimistic with detailed risk analysis. The coverage makes it sound like they're predicting Armageddon. I've watched this pattern repeat for years. Every research report gets filtered through an amplification machine that extracts the scariest possible interpretation. Investors who consume only headlines develop a distorted view of what professional analysts actually believe. The solution isn't to ignore risks. The risks Goldman identifies are real. Valuations are high, concentration is extreme, debt is rising, geopolitical tensions persist. The solution is to understand these risks in proper context. They're factors that reduce expected returns and increase volatility. They're not predictions of imminent collapse. The difference matters for how you respond. Let me give you the framework I use for processing reports like Goldman's. First, read primary sources when possible, rather than relying on summaries. Goldman's actual report is available online. The 100 pages contain far more nuance than any summary can capture. Second, distinguish between base cases and risk cases. Goldman's base case is 7% returns with 25% recession probability. Their risk case is worse. Coverage often presents the risk case as if it were the base case. Third, consider incentives. Goldman benefits when clients stay invested and assets grow. They have no incentive to manufacture false optimism. When they express concerns, those concerns are genuine. But they also have no incentive to manufacture panic. Fourth, focus on actions rather than predictions. What does Goldman actually recommend? They recommend staying invested, maintaining diversification, extending time horizons, and accepting lower expected returns. They don't recommend panic selling or dramatic repositioning. Fifth, remember that all forecasts are probabilistic, not deterministic. Goldman isn't saying 7% will definitely happen. They're saying 7% is their best estimate given current information. Actual returns will differ, possibly substantially. I want to leave you with what I consider the most important insight from Goldman's report. They include a chart showing cumulative returns since their 2021 outlook. The U.S. market has nearly doubled, up 99%. Non-U.S. developed markets returned 60%. Emerging markets returned 24%. China actually declined 14%. 5 years ago, Goldman couldn't have predicted COVID, the inflation spike, the war in Ukraine, the AI revolution, or countless other events that shaped these returns. Yet the fundamental approach of staying invested and maintaining diversification produced strong results despite all that uncertainty. The next 5 years will bring surprises nobody currently anticipates. Some will be positive and some negative. Goldman doesn't know what they'll be. Neither does anyone else. What Goldman does know is that over long periods, staying invested in productive assets has generated wealth more reliably than trying to time disasters. That's not a prediction about 2026 specifically. It's an observation about how wealth building actually works. The investors who will look back 5 years from now and wonder why they panicked are probably consuming crash content right now and preparing to make decisions they'll regret. The investors who will look back satisfied are probably reading reports carefully, understanding nuance, and sticking with their long-term plans. Goldman's report doesn't tell you the market will definitely go up. It tells you that despite real risks, the base case remains positive growth and the optimal strategy remains consistent investment. That's not as exciting as crash predictions. It doesn't generate the same emotional response, but it's what sophisticated analysts actually believe and how they actually recommend positioning. The choice of which narrative to follow is yours. Just make sure you understand what Goldman actually said before deciding how to respond.